All right, we always talk to bulls, and we like to talk to bears as well to put everything in context, including Peter Eliades, the Stockmarket Cycles editor and publisher. Peter has been looking at signals that maybe a lot of people miss, but these are worrisome signals he said you should be paying attention to. They're not necessarily driven by what NVIDIA does or doesn't report after the closing bell. Peter, good to have you back. What are you seeing lately that's got you concerned?
Thanks, Neil. It's good to be back with you. And yes, a lot of things have me concerned. But, you know, one of the dreams of a technical analyst, and it's very, very seldom fulfilled dream, is that you find an indicator or some kind of pattern that picks all the tops and bottoms for you. Well, that's not ever going to happen, okay, because it's so much a combination of so many factors. To me, even as a technician, the ruling factor in the market is psychology. So you try to find ways to measure that psychology. For example, what's going on with the tech field now? Is it overextended? Well, I came up with the idea of dividing the NDX, the NASDAQ 100, which is basically a technology index, by the Dow Jones Industrial Average, which is obviously a conservative average. So when you divide the NDX by the Dow, you get a ratio. If you follow that ratio historically, and the NDX goes back to October of 1985, Neil, so we have a good long history on it, almost 40 years. Of the 2,000 weeks approximately that the NDX has existed, there have been only 3 weeks that closed with a ratio bigger than 46%. Now, it seems like I struck some kind of gold here, because if I tell you what the prior 2 weeks were just before February 9th, a week or two ago, you'll say, oh my God, really? So the first occasion was March 9th of 2000. That was the first week in the history of the NDX that if you divided it by the Dow, it would be over 46%. In fact, at that time, it was 46.2%. Well, fast forward years and years and years. When's the next time that 46% was reached? The week of October 19th, 2021. That was an exact top in the NDX. The March of 2000 was not exact. It was 11 days off. In other words, from the week of March 10th, when that close occurred for over 46%, you had to wait 10 days or 11 market days to see the final high in the NDX. But boy, were you well rewarded if that's what you were looking for, because from that March high in the NDX, Neil, it was down 83.5% in the next couple of years. Okay, so now
what do you see happening now then?
Okay, let's fast forward. Fast forward a couple of years from 2021. Now, that 2021 top in the NDX did lead to a decline of 39% into October of 22. But guess what happened? We didn't go down to the typical areas where that ratio exists. And by the way, I want to say, I'd love to show the viewers a picture, Neil. If they will go to my YouTube channel, and there's a perfect picture of this, exactly what we're talking to now. Just go to Stockmarket Cycles. It's a free viewing. There's no charge for it. Okay. And look at the chart. It's amazing, okay? So listen to this, Neil. On February 9th, 2024, according to my calculations, that was 12 calendar days ago. The ratio NDX to Dow Jones Industrial Average, 46.5%. Only the third time in 2,000 weeks of history where the ratio went over 46%. So,
which means that we're due for a sell-off of potentially that kind of magnitude, right?
Yeah. I mean, it's not statistically significant, Neil. Let's face it. Only 2 occasions.
But it's something you watch. It's something you watch. And you're so brilliant at this, Peter. I just want to step back at it. What are some of the other signals you look at that just tell you, guys, let's pause in this party a little bit?
Okay. Dividend yield. Nobody cares about dividend yield anymore, Neil. I don't want a dividend yield. I want to make capital gains, Who cares about dividend? Well, dividend yields have always been important. A past great market master, probably the one I admire more than anyone, he's been dead now since 1987, was Edson Gould. And he made a huge deal about the dividend yield and analyzing the market. And his big thing back then, up until 1987, was when a dividend yield gets below 3% on the broad averages, the S&P or the Dow, you're in danger territory. Well, if you were to look at a chart now, Neil, and see that if we resuscitated Edson Gould, he would not believe it. We've been below 3% dividend yield for a quarter century now. I mean, we're down in the ones and twos. That's incredibly overvalued in terms of the stock market. I know everyone says that people don't care about dividend yield anymore. When you get to be 65, 70 years old, Neil, and you retire, believe me, you will care
you
about
most
dividend
certainly
yield.
do.
Okay.
Amazing.
So it becomes a very important factor in the market. And it's something that, by the way, this typical ratio of this NDX divided by Dow is probably around 14, 15, maybe 20%, almost throughout history for the last 40 years. So these 46% readings are just showing us there is incredible speculation in the tech indexes. Because if you compare them to the Dow, you say, that it's incredible. No.
It's over the top. It is a distinct, you're right. Real quick, Peter, go ahead. I'm sorry.
I just want to point out quickly that if you look at some of the more broadly based indexes, IWM is an ETF for the Russell 2000, or the value line unweighted or equal weighted index, they're still in a bear market. They have recovered like 50% of their decline from November of 21. They're not at new all-time highs by any means.
So be careful who you're watching. We might be focusing too much on the Chiefs and not the Indians. Peter,
Absolutely.
Always good seeing you, even under these circumstances, my friend. Peter Eliades on that, the Stockmarket Cycles editor and publisher. We believe very, very strongly, just like when we have a Republican on, you should hear from a Democrat, a conservative when you hear from a liberal. But we apply the same to the markets. You should hear from a bear when you're hearing from a bull. And you decide for yourself who's making the compelling argument. After all, it's your money, it's your life.